Welcome back to the deep dive. So today we are on a very specific mission. We're cracking open one of the most famous, heavily debated data sets in modern finance.
Yeah, Eugene Fama and Kenneth French's seminal 2010 research on mutual fund performance. It's a big one.
It's massive. We've got their original academic papers, the raw bootstrap data tables, and a whole mountain of updated performance numbers stretching all the way into the 2020s. And our goal for you listening today is simple, but, incredibly difficult. We are going to find out definitively how much genuine stock picking skill actually exists on Wall Street.
Right. It's the ultimate search for the signal in the noise. And to do that, well, we have to start by confronting the rather brutal reality we uncovered in the first part of this deep dive.
Yeah, that was a heavy one. So just to recap for you quickly, we looked at the net returns of active mutual fund managers, like the actual money investors get to keep after the managers take their fees.
Exactly. And if talent in finance worked like, say, talent in baseball, you'd expect a normal bell curve. A few legends, a big cluster of average players, and a few rookies struggling.
But instead, the data showed this completely broken curve. As an industry, when looking at net returns, the entire distribution of active managers is shifted to the left of pure random luck. On net returns, the entire distribution is worse than luck.
Which means, mathematically speaking, you literally would have been better off handing your retirement savings to a monkey throwing darts at the Wall Street Journal than giving it to the aggregate mutual fund industry.
Yeah, but we promised a twist today. Because the moment you look at the exact same managers over the exact same period from 1984 to 2006, but you look at their gross returns, the picture completely transforms.
Right, and just to clarify, gross returns meaning the raw performance of their stock picks before they subtract those management fees.
Exactly.
And it does more than transform. It really reveals the true nature of the market. When you plot the distribution of those gross returns, the actual curve sits exactly on top of the simulated distribution for pure random chance.
So it's not shifting left and it's not shifting right.
No, it's lying perfectly flush with the simulation of zero skill. Like, to put a specific number on this, the value-weighted growth three-factor alpha in this original sample is 0.21% per year.
Okay, let's unpack this because there's some jargon there we should clear up for everyone listening. So value-weighted just means we are giving more mathematical weight to the massive funds where most of the actual money is invested.
Yeah, rather than treating a tiny $1 million fund the exact same as a $100 billion behemoth, you have to weight it.
Right. And the three-factor alpha part, that's how we measure actual unique skill. Because it controls for the fact that small companies and cheap value companies historically bounce around differently than the broader market.
Exactly. You don't get to claim you're some genius stock picker just because you bought a bunch of small cap stocks during a year when literally all small cap stocks went up.
Yeah, a rising tide lifts all boats.
Right. So the three-factor model strips away those broad market tailwinds so we can see what the manager actually contributed.
So when you strip away the market tailwinds and you look before the fees are taken out, the aggregate outperformance is just 0.21%, which, in the chaotic realm of financial markets, that's basically a rounding error.
It is statistically indistinguishable from zero.
So before Wall Street takes its cut, the entire mutual fund industry is basically a giant room of coin flippers.
The aggregate data strongly suggests exactly that. Gross of fees, the industry as a whole is neither good nor bad. It's just noise.
But this introduces the central question we are trying to answer today. If the aggregate room looks like pure noise, could there still be a small number of genuine stars hiding within that noise?
That's the million-dollar question, or trillion-dollar question, really.
Yeah. Because think about it. If you put 5 legendary poker players in a massive stadium filled with thousands of people who are just blindly flipping coins, the average outcome of that entire stadium still looks like a coin flip. The noise of the crowd drowns out the skill of the few. So how do we actually isolate the stars?
Well, Fama and French designed this beautifully rigorous way to figure that out. Give them full credit for the design here. But before we can hunt for that hidden skill, we have to talk about the simulation itself. We must be absolutely certain that our baseline model of pure luck is scientifically bulletproof.
Right. Because if you're comparing reality to a broken simulation, your conclusions are totally useless. You have to know exactly what a zero-skill universe looks like first.
Exactly. And this requires two very subtle structural choices in their methodology. Choices that, usually get buried in academic appendices, but they are completely load-bearing for the truth.
What's the first one?
The first choice involves how they actually build that simulated universe of luck using a technique called bootstrapping. They take historical data and randomly sample it to create these alternate realities. But instead of randomly scrambling the returns of individual funds independently, they resample whole months across the entire market simultaneously. This is called joint month resampling.
Wait, let me make sure I'm visualizing the mechanics of this. If you independently scramble the returns fund by fund, aren't you accidentally creating an impossible alternate reality? Like creating a simulated month where one specific small cap fund crashes horribly, even though the entire small cap market is booming that month.
Yes, exactly.
So by pulling the whole month across the board, you preserve the weather of the market. When the small cap sector experiences a massive rally, all small cap funds rise together because they are caught in the same financial weather system, right?
Yeah. The market weather is the perfect way to visualize it. Fama and French are deliberately preserving the factor correlations. If you bootstrap fund by fund independently, you destroy that correlation. You would essentially create a simulated universe with tails that are artificially thin.
Oh, I see.
Yeah, and if your baseline simulation of luck is too narrow, then when you compare it to the messy reality of the real world, you'd look at a manager who just got lucky in a booming sector and falsely conclude they're a genius. You would wrongly reject the null hypothesis.
You trick yourself into thinking the coin flippers have skill just because it happened to be raining money on their specific sector that month.
Exactly. That is the trap they avoid with joint month resampling. Now, the second crucial methodological step is the zero alpha adjustment.
Let's break down how that adjustment actually works, because it sounds a bit like mathematical wizardry.
It's actually a very grounded, logical step. Before they run their simulation to figure out what pure luck looks like, they systematically force every single fund's true alpha to zero. They literally calculate each fund's historical outperformance or underperformance and physically subtract it out of their returns.
So they are essentially leveling the playing field. If a manager historically beat the market by 2%, they dock them 2% in the simulation data.
Yeah.
And if another manager lost by 2%, they bump them up by 2%.
Right. By neutralizing those historical returns before the bootstrap even begins, they guarantee the simulation tests a true null hypothesis. If they skipped this step, they wouldn't be testing a no-skill universe. They would just be testing whether the existing skill in the real world persists into the simulation.
Okay, so through joint month resampling and the zero alpha adjustment, we now have our pristine baseline, a simulated universe where we know with absolute mathematical certainty that not a single manager possesses an ounce of skill, literally testing for no skill.
Which sets the stage for what I think is the most revealing experiment in empirical finance. Because Fama and French don't stop there. They take the zero-skill universe and they run the simulation 9 different times.
Wow, 9 times.
Yeah, but in each subsequent run, they systematically inject a tiny random amount of fake true alpha into every single fund.
Wait, how do you inject fake skill into a data set?
Think of it like adding a microscopic magnetic bias to a room full of spinning coins. They draw a random number from a normal distribution and add it to the fund's returns. Some funds get a tiny positive bump, some get a tiny negative bump. They are artificially extending the variance, and they do this across a very specific scale of standard deviations or signal levels.
So they're basically slowly turning a dial.
Yes, exactly. They start at a sigma of 0% per year, our pure luck baseline. Then they turn the dial to 0.25%, injecting just a whisper of variance, and 0.5%. And they keep turning this dial up, 0.75, 1.0, 1.25, 1.5, 1.75, all the way up to an injected standard deviation of 2.0% per year.
Got it.
Each turn of the dial produces a new, slightly wider bell curve, showing what the market would look like if that exact amount of skill existed.
Here's where it gets really interesting. Because just to ground this for you listening, we have 9 different simulated universes, each with a slightly higher level of injected artificial skill. The final step is to take the actual messy real-world data of thousands of mutual fund managers, overlay it on top of those 9 simulated curves, and see which one forms a perfect match.
Yes.
And whichever number on the dial matches the real world, that is our definitive answer to how much skill actually exists in finance.
And the statistical footprint of one specific simulation aligns almost perfectly with the actual gross return distribution.
I feel like we need a drum roll here. What was the number on the dial that matched reality?
The magic number is 1.25%
Wow.
per year. That is the upper bound on the cross-sectional standard deviation of true alpha. It's the absolute ceiling of genuine stock-picking skill in the U.S. active equity fund industry.
We really need to translate that into human terms, because the standard deviation of that size sounds a bit abstract if you are an investor staring at a list of 4,000 mutual funds trying to pick a winner for your portfolio.
Right.
What does that distribution actually look like in a room full of people?
Well, when you apply that standard deviation to a population of 4,000 active managers, the math gets very stark. In that entire universe, only about 100 of them possess a true alpha above 1.6% per year.
100 out of 4,000, that is an incredibly thin slice of the pie.
Well, the slice gets thinner.
Yeah.
When you look for the true outliers, the managers generating a genuine, durable skill level above 2.5% per year, you only find about 40 people.
But wait, 40 people out of 4,000 highly paid Ivy League educated professionals backed by armies of analysts.
There's 40 real stars hiding in all that noise. But, the nature of a normal distribution introduces a dark symmetry. If there are 40 real stars on the extreme right tail of the curve, there must be a corresponding left tail.
There are 40 anti-stars.
Exactly. There are roughly 40 real losers in that same population. Managers who possess a true systematic alpha below negative 2.5% per year.
Oh, wow.
Yeah, they are not victims of bad market weather. They are genuinely systematically bad at picking stocks.
And what about the thousands of managers sitting between those two extremes?
The vast majority of the industry, pure coin flippers. Their performance, positive or negative, is mathematically indistinguishable from random chance.
Wait, let me push back on this because this feels like a solvable problem. If we know statistically that there are 40 real Warren Buffetts in this data set, 40 people generating a genuine 2.5% above the market, then why is the stock picking debate over? Why does everyone say you should just buy a boring passive index fund? Just go find one of the 40 stars and give them your money.
Because identifying those 40 stars in advance is practically impossible due to the time horizon problem. Volatility acts as a cloak.
But if someone beats the market by 2.5% every single year for 10 solid years, you're telling me that's just noise. I mean, that seems mathematically undeniable.
It feels undeniable to our human intuition, which, loves to spot patterns. But individual stocks are incredibly volatile. The noise of the market is so deafening that a manager with a true underlying skill of 2.5% over a 10-year or even a 20-year track record does not statistically separate from a lucky amateur who just had a good run.
Seriously, a 20-year run could just be luck.
The signal-to-noise ratio is simply too low. The math shows you'd actually need 30 to 40 years of continuous data to confidently prove that their 2.5% outperformance was actual skill and not just variance.
And nobody has a 40-year track record. By the time you gather enough data to statistically prove they are a genius, they're already retiring to a golf course in Florida.
Exactly the problem. But the time horizon isn't even the biggest obstacle. Even if you possessed a crystal ball and could miraculously find one of the 40 stars making 2.5% on day one, you hit the ultimate structural trap of the industry, the fee wall.
Oh, let's run the math on the fee wall for the listener. Let's assume you perform a miracle and hire one of the 40 stars, and they generate that genuine 2.5% true alpha. In this data set, the average management fee is 1.1%. You take their 2.5%, subtract the 1.1% fee, and you only keep 1.4%.
And that is the absolute best-case scenario for the top 1% of the industry. Now apply that 1.1% fee to the thousands of managers in the middle of the curve.
The coin flippers. Since their true alpha is 0, paying a 1.1% fee basically guarantees a negative return. This is the ultimate tragedy of the whole thing. That 1.25% standard deviation of true skill is literally smaller than the fee wall of 1.1%. The tail of genuine skill just isn't long enough to clear the cost of admission.
Which perfectly explains the devastation we saw in the net returns earlier. When the cost of active management is larger than the microscopic amount of skill that exists, the aggregate damage is immense. For context, the equal-weighted net four-factor alpha for this era is negative 1.13% per year. Merely participating in the active management game slowly bleeds your capital.
But what happens to the investors trapped on the other side? Like the ones stuck with the 40 genuine losers who have a true alpha below negative 2.5%. Because if fees are eating the stars alive, the losers must be causing absolute carnage.
The data on the left tail reveals an incredibly grim anomaly, actually. The actual left tail is fundamentally worse than the symmetric normal distribution predicts.
Really, how much worse?
Let's look at the bottom first percentile. In our baseline simulation of pure luck, the worst-case scenario, the absolute unluckiest a coin flipper could possibly be, is an alpha of negative 2.53.
So negative 2.53% is the floor for bad luck.
But when we look at the actual real-world data for that bottom first percentile, the actual value destruction is negative 3.99.
Negative 3.99. So they are pushing way past the boundaries of bad luck.
The right tail of stars fits the prediction of a normal distribution perfectly, but the left tail is terribly fat. Bad managers find ways to systematically destroy value far beyond what random variance allows.
Why? Like, what is the actual mechanism making them so reliably terrible?
It really comes down to human psychology and structural flaws. They engage in style drift, abandoning their stated strategy to chase a hot sector they don't understand. They overtrade, racking up massive transaction costs. They apply leverage at exactly the wrong time, amplifying their losses during a downturn.
Jeez.
Yeah, a coin flipper just passively rides the variance. A truly bad manager actively digs the hole deeper. It turns out there are far fewer ways to be a systematic genius than there are to be a systematic disaster.
It's like finding out the casino isn't just rigged against you, but some of the dealers are actively setting the chips on fire.
It completely reframes how we should view risk in active management.
Okay, so we have this incredibly clear, painstakingly verified picture of the industry. But there is a massive elephant in the room that we have to address. The original Fama and French dataset, the numbers we just walked through, stops in September of 2006.
And the financial landscape has undergone a tectonic shift since 2006.
Tectonic is putting it mildly. I mean, think about the world you and I live in today. Passive investing in ETFs went from a niche academic idea to the absolute default for retirement accounts. Trillions of dollars fled active management. Fees across the industry dropped by nearly 30% on a dollar-weighted basis.
Supercomputers became cheap, too.
Exactly. We now have machine learning, alternative data, high-frequency algorithmic trading. An active manager today has technological tools that a fund manager in 1995 couldn't even conceptualize.
And the environment became fiercely, brutally competitive. The weakest funds should have been entirely culled from the herd.
Right. The bar for survival has never been higher. So logically, with cheaper fees, infinitely better technology, and only the strongest players surviving, the active managers post-2006 should look significantly better. The numbers should be healthier.
You would certainly formulate that hypothesis, but when we extend the data set and run this exact same rigorous analysis through to the modern day, the data drops an absolute bombshell.
Walk us through the modern numbers.
So in the full expanded sample from 1984 all the way through 2025, the value-weighted net three-factor alpha is negative 0.92% per year. And crucially, it carries a t-statistic of negative 3.25.
Let's clarify the t-statistic for you listening. That is a measure of statistical certainty, right? Generally, anything past a -2 means the probability of this happening just by chance is practically zero. So negative 3.25 means this isn't a fluke. It's a mathematically proven structural failure.
Yes, the negative alpha is highly statistically significant, but that's the full 41-year sample. If we isolate just the data from the post-2006 era, this modern, high-tech, lower-fee utopia you just described, the net alpha drops further to negative 1.32% per year, with a t-statistic of negative 3.33.
Wait, fees got 30% cheaper, technology got infinitely better, but the net alpha got worse.
Deteriorated. And because we know the management fees dropped, the fact that the net returns still got worse implies something deeply troubling about the underlying gross returns. Which brings us to the final devastating statistic of this analysis.
Hit me with the gross numbers.
Remember how the entire premise of today's deep dive was that before fees, the industry's gross returns were basically a coin flip?
Yeah, they hovered at a harmless 0.21%.
Well, in the post-2006 data, the point estimate for the value-weighted gross three-factor alpha plummets to negative 0.54% per year, with a t-statistic of negative 1.36.
Negative 0.54%, before the fees are even subtracted.
Before Wall Street takes a single dime.
Let me synthesize this because the implications are just mind-bending. That 1.25% number we found earlier was the absolute ceiling of historical skill, the 40 stars hiding in the noise. That was the peak. But in the modern era, the industry's raw underlying stock-picking skill has actually turned negative. The literal coin flipper, the monkey throwing darts, is now reliably beating the highly paid stock picker before the fees are even factored in.
The cross-sectional bootstrap for the modern era confirms it. The entire actual distribution has shifted to the left of luck. The skill didn't just hide, it vanished.
How is that even possible? How do armies of Ivy League analysts with supercomputers perform fundamentally worse than random chance?
It leaves us with an incredibly provocative question, and it's something for you to mull over before our next deep dive. If active managers are now reliably losing to the index before fees, despite having infinitely better technology, infinitely better data, and faster execution speeds than they did in the 1990s, who exactly is on the other side of their trades? Have our markets become so hyper-efficient, so completely dominated by relentless self-correcting algorithms, that the mere act of trying to actively beat the market is precisely what guarantees your loss to it?
Oh man, the ultimate paradox. You try to outsmart the machine, and in doing so, you just become the liquidity that feeds it. We started today looking for a clean, visible x-ray of financial skill. Instead, we found a landscape where the skill is so microscopic it gets entirely swallowed by the cost of looking for it. And now, the machine itself might be changing the rules entirely.
In episode 3, we take everything we know and we run it through 15 more years of data. Passive investing has become the default. Quantitative tools are cheaper and more powerful than ever. You would think active management should look better now.
3 previews for you. 1, the value-weighted net alpha in the full sample is negative 0.92% per year, with the t-stat of negative 3.25 worse than the original, and statistically significantly negative for the first time. 2, even adding the RMW and CMA factors from the 5-factor model does not rescue active managers.
And 3, there is one decade in the entire 41-year history that is so bad for active equity that it makes every other decade look easy.
And it is exactly the decade you would least expect. We will see you in episode 3 of this deep dive.